This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, August 12, 2026, and this is the After Hours session. Now, let's get into it. The Fear and Greed Index has collapsed to 14 out of 100. We are deep in fearful territory, where investors are pulling back from risk and piling into safe havens. As of 1918 ET on August 12th, the US dollar is reversing its earlier declines to close higher, while gold surges to new highs. Let's look at what the data is telling us right now. Looking ahead to the immediate horizon, we have three key economic releases on the docket. First, initial jobless claims arrive tomorrow, Thursday, August 13th. That is a weekly gauge of labor market tightness. Second, also on Thursday, producer price index data comes out, giving us another layer of inflation detail alongside today's CPI confirmation. And finally, on Friday, August 14th, we get retail sales month-over-month figures, which will test consumer spending resilience alongside the GDP now estimate.
The most critical watch tomorrow is definitely the jobless claims. With non-farm payrolls having contracted by 23,000 last month, any surprise in the claims data could accelerate the narrative of softening growth versus the sticky 3.3% CPI we saw today.
Here is the snapshot of the market as of this evening. The Fear and Greed Index sits at 14/100. The VIX is at 15.46, up 0.56 points. The Dow Jones Industrial Average closed lower, while Nasdaq indices led the upside charge in equities. But in Forex, the story is clear: dollar strength and gold dominance. Dollar-yen closed at 159.425, up 0.1%. Gold is at $4,401.94, up 0.7%. Euro-dollar is at 1.1535, down 0.7%. Aussie dollar is at 0.705695, down 0.9%. And dollar Swiss is at 0.812135, up 0.13%. Breaking news moving the needle today. First, according to Forex Live, the CPI came out as expected. The summary line reads, CPI as expected. Dollar reverses declines and closes higher. That as expected, print is actually doing heavy lifting for the dollar. We are seeing a structural shift where the market is pricing in persistent stickiness rather than relief. With core PCE holding at 3.29% and the 10-year 2-year yield curve flattened to just plus 0.48 pp, the Federal Reserve's ability to ease is severely constrained by labor market fragility, even as headline inflation refuses to break below the 3% threshold. Next headline, UBS commentary notes lower real rates are reviving gold demand, flagging dips as buying chances.
This is the divergence we need to watch. Spot gold is surging to $4,401.94, yet leveraged fund positioning remains bearish at minus 670 net. This suggests spot demand is decoupling from speculative sentiment. That is a classic precursor to forced covering, when the price keeps climbing despite the shorts.
Third headline, U.S. stocks closed mixed. The Dow is lower. Nasdaq indices lead the upside charge.
That equity split is interesting because it contrasts with the broader risk-off sentiment in Forex. In FX, we are seeing a unified flight to safety in dollar and gold. The equity market seems segmented, but the currency flows are broadly consistent with a defensive posture.
Fourth headline, Apple in talks to pay publishers for content to power AI Siri, WSJ says. Does this move the FX desk? Negligible for our primary assets. It doesn't touch the yield curve, the Fed funds rate at 3.63%, or the inflation mechanics driving the dollar. We can skip it. Moving on to our detailed analysis. Let's start with the flagship, dollar-yen. It is trading at 159.425.
Technically, the structure is compressed against its 5-day high of 159.4625. The current price of 159.425 sits just 3.5 pips below the breakout threshold. The 5-day range of 156.667 to 159.4625 indicates a strong upward bias with no significant pullback support until 159.1985, which was today's low. We are essentially pressing against a glass ceiling.
But look at the positioning underneath that ceiling. Leveraged funds hold a massive 60,825 net short yen position. That is a liquidity vacuum. Any yield spike or Bank of Japan intervention rumor could trigger a violent repricing event. The short side is overwhelmingly dominant here, creating a crowded trade.
I have to challenge the idea that this breakout is straightforward. A 60,825 net short position is unsustainable without a catalyst. If the yield curve flattens further or the Fed hints at a pause due to the softening non-farm payrolls of -23K, the squeeze will be vertical. Betting on a breakout here is betting against the largest contingent of traders in the book. The risk/reward asymmetry favors waiting for the squeeze initiation, not chasing the top of the 5-day range.
SPECTER, you're looking at the trap, but I'm looking at the fuel. The Fed funds rate is 3.63%. Inflation is 3.3%. The market cannot cut aggressively. Those yen shorts are fundamentally exposed to further widening of the rate differential. This isn't just a technical squeeze. It's a fundamental repricing of the carry trade because the US rate simply won't drop fast enough.
Exactly. The weekly change in those yen shorts was 61,403 contracts. Speculative capital is still adding to the position despite the fear and greed index hitting 14/100. They are ignoring the fear gauge to chase yield differentials.
So we have a technical break looming against a backdrop of extreme crowding. Let's pivot to gold. Gold is at $4,401.94.
Gold has established a multi-day ascending channel. Support is confirmed at yesterday's close of 4,371.55. The current price is 4,401.94, which is beneath the psychological and structural ceiling of 4,435.4, which is also the 5-day high. We are testing the upper bound of the range.
The danger here is the divergence. Price is at 4,401.94, but leveraged funds are bearish at -670 net. Usually, when price runs away from positioning, it means the trend is healthy, but the crowding of longs later could exacerbate a pullback. However, with the fear and greed index at 14/100, this flight to safety is structurally supported by the macro regime.
This makes sense. The 10-year yield is at 4.7%. With core PCE at 3.29%, real yields are being managed by inflation fears. Gold is acting as the hedge against that sticky inflation. The UBS commentary about dips being buying chances aligns with this. We aren't seeing profit-taking. We are seeing accumulation as a hedge against the 3.3% CPI reading.
There's no direct COT data for gold in my flow feed for this specific pair, but the mechanism is similar to the FX flows. Capital is rotating out of high-beta currencies and into hard assets. The -670 net short in leveraged funds is small relative to the price move, suggesting institutional spot demand is overpowering the speculative noise.
Next up, cable. It is trading at 1.3505.
Cable is sandwiched within its 5-day range of 1.34343 to 1.35308. It is holding at 1.35055, showing less directional urgency compared to the aggressive push in dollar pairs. It's consolidating near the mid-range.
This is the outlier. While everyone else is getting hammered or rallying uniformly, pound is unique. Leveraged funds are plus 38,174 net long pound, with a week-over-week accumulation of plus 37,416 contracts. It is the only major currency with significant speculative bullish conviction.
That aligns with the RBNZ tightening path mentioned in the headlines. Economists are debating the expectations survey, but the market is pricing in a stance that supports the Kiwi and potentially spillover effects to pound if UK data holds. The strong institutional positioning gives pound a floor that euro and Aussie lack.
Be careful calling it a floor. The broader sentiment is still fearful. A 60,825 net short in yen and a 52,205 net short in euro dominate the books. Pound is a bright spot, but in a 14/100 fear environment, correlations tend to tighten. If risk aversion spikes further, even the long pound might face pressure unless it breaks cleanly above 1.35308.
Let's check the laggards. Euro-dollar is at 1.1535.
Euro-dollar is well below its 5-day high of 1.1581. It is struggling to hold above the recent consolidation floor of 1.15434. That confirms bearish momentum.
The CFTC data backs that up. Leveraged funds are 52,205 net short euro. Asset managers are long, but the active traders are betting against the euro. There is little room for further downside acceleration without a fundamental catalyst, but the momentum is clearly down.
Finally, let's look at Aussie dollar. It is at 0.705695.
The 5-day range is 0.70224 to 0.7078. We are closer to the bottom of that range, indicating weakness.
Interestingly, leveraged funds are plus 40,637 net long Aussie. This creates a weird dynamic for Aussie yen. You have the longest Aussie flow combined with the shortest yen flow. This pair holds the highest concentration of institutional leverage.
That is the ticking time bomb. Aussie yen is a carry trade vehicle. If the fear and greed index drops further or volatility expands, that plus 40K long Aussie and minus 60K short yen combo becomes incredibly vulnerable. A sudden jump in yen yields would force unwinding on both sides.
To wrap up our analysis, let's synthesize. What is the overarching theme as of August 12, 2026?
The theme is structural dollar strength driven by sticky inflation, but with binary risks depending on who blinks first. Pulse highlighted that the Fed cannot cut aggressively, with CPI at 3.3%, which provides the fuel for dollar pairs. Grid pointed out that dollar-yen is technically ready to break its 5-day high of 159.4625, but SPECTER correctly identified the counterforce. The 60,825 net short yen position is a loaded gun. Meanwhile, for gold, Grid noted the resistance at 4,435.4, while SPECTER highlighted the dangerous divergence between price and bearish positioning. The opportunity lies in the safe haven bid, continuing as long as the fear and greed index remains below 20. And for hedging, CIPHER showed that pound is the only currency with sustained bullish flow, making it a potential hedge against a broader dollar squeeze if the yield curve flattens further.
Key takeaways from today's session. First, the dollar is strengthening not because of strong growth, but because inflation is sticky at 3.3%, preventing rate cuts. Second, dollar-yen is testing a critical technical breakout at 159.4625, backed by extreme short positioning that could either fuel the rally or trigger a violent squeeze. Third, gold continues to act as a safe haven, decoupling from speculative positioning as spot demand rises. Tomorrow, watch initial jobless claims and PPI data. These will be the litmus tests for whether the labor market is truly softening or if inflation remains the dominant factor. This is ShadowQuant Forex edition. Stay sharp. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the Tokyo session where we will see how these calls play out. Until then, trade safe.